Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. I have a request. Actually, I have a bunch of requests coming in, and I'll get to those whenever I get time, basically. And I'll just kind of do them in the order that I get them, unless you asked for like a bunch in a row. I might stagger yours with other people's requests in there. So we have a request for Pfizer, which doesn't. Pharma companies are always a little tricky with my method because I use a lot of historical patterns basically and try to kind of extrapolate those or take them and use those as a guide for maybe the valuation or when to buy and things like that. But drug companies have patent cliffs and they're developing new things that aren't necessarily predictable, I would say, in terms of their success. And so you're always kind of rolling the dice. This is the way I view it with a pharma company. And really, what I try to do basically is buy them when they're not very popular, when they're pretty cheap, and then kind of just hold them and hope that kind of something positive comes along. Now, sometimes you can tell when like a patent's going to run out, well, you can always kind of tell, sort of. I mean, there's always litigation and they change it. I mean, I just think it's really unpredictable, so I just try to accept that. But I have had pretty good success with these. I had a smaller, I would probably call them more of a biotech, but they had quite a few different products that they were working on that I thought were interesting. I think it was called Alexion Pharmaceuticals. They got bought out. This was a Cyclical Investors Club pick, so I never wrote about it publicly. But they got bought out just a couple months after we bought it, and really just bought it because it was cheap. And so if you can do that, especially on the smaller ones, not super small, not like super speculative, but where they have at least a couple products out that are okay and they're still doing a lot of research, other companies can see the value in that too. And hopefully, if they buy it, and you can cash out a pretty good chunk of change, which is what we were able to do there. Also with Merck, which is on the larger end, which would be more comparable to Pfizer, I basically followed this same methodology. It was cheap when everything else in the market was expensive. I bought this one near the it was in, I think, March of 2021, so like 2.5 years ago. It's up like 65% because it was just cheap, pretty cheap when everything else was expensive. And then, they kept finding new uses for Keytruda, and I think they also had some COVID boost too with some of their stuff. So and it ended up doing very well. I also own Bristol Myers. It's been like flat basically. So it's one of those where I'm just kind of waiting around to see if they come up with something, but I haven't lost like a ton of money. I think that Pfizer is going to fit in the same sort of category. But I am prepared to buy this one, and it's actually getting pretty close to a buy price. Now, when I buy things, it's like I usually equal weight things on my initial purchase of like a 1% of like a portfolio. So for most people, that's going to be a small amount. And then if I have a good winner that doesn't ever get overvalued, I just let it run. So I don't rebalance it for the sake of having an equally balanced portfolio, but I kind of place my equal bets for the most part. As always, this isn't like investment advice to anyone else. I'm just always sharing kind of what I'm doing. Definitely these investments can lose money. So if you think what I'm saying makes sense, you can make your own decision about what you want to do. So here are my thoughts on Pfizer. A lot of times what you're doing is just like avoiding mistakes in investing. If you start off with the attitude of not making mistakes, you'll probably do better off. If you just took the whole S&P 500 and said, okay, which one of these are probably mistakes right now, and like cross them off and kind of focused on the ones that where you couldn't see like an error, and then over time, especially if you analyze your mistakes, you just get better and better at kind of finding them and avoiding them. And that's probably a better way to go about. I know it's a better way than go about investing than trying to pick winners, which is really like big long-term winners is really hard. People can do it, but you have to have kind of a special talent and a lot of experience to do it. So looking at Pfizer, what I want to do is avoid. What we did was I never bought it here, and I did buy Merck around the same time. So if you look at the difference in performance, Merck is up like 65% and Pfizer's down a lot. I don't know. I'll check in a second. But really what I want to look at here is earnings growth. I would say this has mostly been flat over this time period. And which is the dark green shaded area. But when we get closer to today, we do see some earnings growth actually occurring. So let's shorten this to 11 years. Okay, so we do have pretty decent earnings growth. When I calculated it out, this big spike is all due to COVID. So if you were thinking pretty clearly during this time, you would have realized that this isn't going to last forever. I mean, I wrote a lot. I didn't write about Pfizer specifically, but I wrote a lot about this. I called it a boom bust. This was kind of a classic directly linked to COVID boom in earnings, and then they had the bust that's happening right now. And so what I did was when I calculated their earnings growth, I forget the exact time frame, but I took it up to like the end of 2019, the beginning of 2020, and it ended up being like a little over 5%, which is kind of what you see here if you kind of averaged all those together, just roughly eyeballing it. So 5% earnings growth is slow but adequate. Right now I have a 4% basic threshold. So I want a business to have a history, once I control for buybacks and everything else, of at least 4%. And I would say Pfizer's just a little bit over that. So it's a slow grower unless they come up with like something big at some point. And then if you get lucky, then you just kind of hang on to it. But if you don't, 5% growth isn't bad if they can keep doing that. Provided you buy it at the right price and everything like that. So that's really what we're looking at here. Let's take a look at just how far. I want to say, this is 22, so it didn't even peak until later in 2021. So it's not doing horrible since early 2021, but it's not doing well. It's probably pretty flat actually. Where were we here? 33. Actually, it's like flat from this little beginning here, I think. So, but anybody that bought during this boom time is down a lot. If you bought near the peak, you're down 40 or 50%. So, and the key there was, and it probably didn't look. So here's the problem that people get into. And I was aware of this because my specialty are cyclical stocks. So this was a boom bust cycle, but I hesitate to call it a cycle. It's really a boom bust period, which is similar to what deep cyclical stocks go through. So you can imagine a newer investor or one who was kind of caught up in everything was going on would look and say, look, this is a 13 PE. They just grew 100%, grew earnings 100%. It's trading at only a 13 PE ratio. Look at what a great deal this is. And it actually only got better. Like the next year, which it wasn't down that much from there, it was trading at an 8 PE. It had grown earnings 150% over the last 2 years, right? So that all sounds really good. And except for you have to take into account that this isn't going to continue. So the market knew that it wasn't going to continue. But if you didn't know any better, you could easily get attracted into this during this year right here, because the basic PE and the growth looked fantastic. And so that's what a lot of probably people did. And unfortunately, they've lost money now. But I mean, you can learn from the key is just to learn from your mistakes. I started cyclical investing because I lost a bunch of money on a cyclical stock, and I just couldn't figure out what I had done wrong. It was kind of like this. Although I think you could use logic with the COVID thing and realize that it wasn't going to go, that wasn't going to go on forever. Um, in commodities, it's just like an oil company, I think, and I just didn't understand the cycles that they went through. So I spent a lot of time, and once I learned how that all worked, um, I really learned from my mistake, and then I started actually making money on it on the other end because I understood something that was going on, and a lot of the professional investors understand that, but a lot of individual investors have to kind of learn it the hard way. And so I think a lot of people probably have learned the hard way with Pfizer here. So now the question is, okay, it's down to where it was going into, pre-COVID back here, basically 2018. So it's like 4 or 5 years ago. Is it a buy? Is it a good buy now, or when would I buy it? So let's get into that. So we need a couple things: earnings yield and earnings growth. Because these guys have quite a bit of M&A that they do, I don't think there's any like giant ones from them recently, but I like to use, I'm going to use the basic earnings just because they're more conservative. So that was like $3 and something, and the basic earnings are $2.87. And then I'm looking forward since this is going down. And so this is kind of the most basic earnings number that I can use here. And it's like where that was pre-COVID, basically. So that seems like a fair starting point. Once things kind of bottom out, and then we'll see what they produce in the future and what kind of growth they can maybe get out of there. But if we can buy, so we're looking at a 9 PE. I'll see what I came up with, along with 5% growth. So let's take a look at my spreadsheet here. Here's the growth rate that I calculated. I think this was pre-COVID, 5.22%. I use normal earnings when I calculated this one, so it might be a little bit lower if you did the basic earnings for the whole thing. But I think it's like that 4 to 5% range is kind of the growth that you're looking at in terms of what a base expectation would be. This is 3-year revenue growth. That's going to be influenced by COVID, so it can be ignored. And eventually this will actually turn negative, probably after next year, because you have the big spike up and then it comes back down. And so I would ignore it when it's negative too. So it's just whenever you have something that's going through a boom and a bust, some things you have to kind of learn just not to pay as much attention to. Now, let's see what I have for the PE here. So let's see, the PE ratio I have right here is 11.54. That probably takes into account debt, and let's see here. I'm just looking. I don't know for sure if I take into account debt there or later in the formula, but I'm using the basic earnings here, and that's pretty cheap. We get an earnings yield of 8.66%. So the way I like to think about this is if I invested like $100 in this business and I bought the whole business, it could pay me back like $8.66 a year, and that would grow at 5%, 5.22% a year. And then I calculate how much money that would produce over time on my $100 investment, which is what's going on here. So you have the 866, it's growing at that 5%. So this is the first year with the 5% included, including the original $100, and it builds and builds, right, until you get to 10 years where you've slightly doubled your money. And then I plug that into a CAGR calculator, and you start with 100, you end with 215, right? It's pretty simple. And then it spits out 8%, which is exactly the threshold that I use to buy stock. So this is basically right at like a normal buy price. You just think of it as like an 8% earnings yield growing at 5.22% for 10 years. You could expect to collect that 8% a year if you own the business. So you're probably going to do okay if all those things work out. Now, that's not spectacular, but if they come up with a new drug or the market changes its mind, maybe some point in the next decade, interest rates go lower, all those things can kind of help you get a better return than 8%. I actually aim for about double that. And when these work out over time, usually there's a period where you can get double that. So the other thing to take into consideration is our recessions. And I think there's at least a lot of recession danger right now. So what I do is, let's turn this back to regular earnings really quick. Now, when we go back to 2009 and 2008, if we just take a quick look at this, so we have a PE of like 5. I've explained in a lot of videos how I come up with my recession PE number. But basically it takes peak earnings, it takes the low price, which is $13.26, and it converts it to kind of the most pessimistic PE you could think of. In Pfizer's case, because I know how horrible that the market hated anything to do with healthcare at this time, because a lot of people were worrying healthcare was going to get nationalized, and we were in a depression basically at the same time. If you look at health insurance, drug companies, pretty much anything to do with healthcare, you're going to just see these crazy low PE ratios. And earnings did fall this next year, so there's a little bit of cyclicality there, but not enough to justify kind of what was going on here. So what I've done with these guys is I've taken this recession PE, which you can the rough estimate here is 9. So that's like almost 10, actually, almost double. And I just blended those together. So I would say this little 2020 blip was probably too shallow because the Fed rushed in and kind of saved the day, and the government came in and saved the day. But this one's probably too pessimistic. So I just kind of blended these together to get a rough recession PE estimate. And then what I do is I say, okay, that's the most pessimistic PE using the peak earnings. What would it be? How close do I want to get to that super pessimism before I would buy? So and in this case, I use within 40% of that. So that average was about 6.75 for the recession PE from those two recessions. Then I add 40% to that, and it gives me a 9.45 PE. And right now it looks like, I don't know if we're at 11 or if I calculated that slightly differently for this, but so that's kind of where I'm at. The main thing is to know this is kind of it's like middle of the road estimate that I think makes sense. And then I adjust for debt. I adjust for debt too, which is what I was trying to figure out there, and I forget exactly how I did it. I might not be able to actually show how I did it in the spreadsheet. But what I do is, and FastGraphs has I just emailed them today and they said they're going to fix this. They don't have it here. But I basically take the total enterprise value and the difference between that and the market cap, and I increase the stock price by whatever that percentage is to pay for in theory, for the debt that you would be buying if you bought the business. Produces a little bit more conservative valuation for companies that have more debt, and a little more aggressive valuation for those that are holding cash. I don't think if I recall, it wasn't a big difference. Actually, I can look and see what the difference is in stock price. Yeah, so yeah, they had almost none. All right, so it wasn't a big factor with them. So the current price is right at my kind of standard buy area, and the recession price is just a little bit lower, down a little closer to $30 per share at $30.57. I would probably plan on taking a position there, just a small 1% position, and then just holding and seeing what happens over time. One thing I would like to point out is when you have a slow growth business like this that you think you're just going to kind of chill and see if something good develops and you're just buying it at a good price, and you think you can get pretty decent returns, is I want the capital allocation to match the traditional earnings growth. And what I mean by that is, and I like to get it with slow growth companies, I don't usually care about dividends at all, but with slow growth companies, I think of the dividend, one, is just a reasonable capital allocation. If they can't grow their business, give me the money back, that they're earning, and then I can allocate it somewhere else. And so in this case, their dividend yield is about 5%, and they're probably not going to be cut. I would assume they're not going to be cutting that anytime soon. So if you think, okay, you're sitting in cash, I think my cash right now is yielding like 5.4% roughly, or 5.3, 5.4. With no upside potential, we'll say, and no downside potential for the cash. Well, Pfizer is at least paying me back 5% each year while I sit around and figure out if they're going to come up with like a new drug that's going to work or something like that. So now the stock price might go down more, but it's probably not going to go down like a crazy number unless something really weird happens. So I don't see the downside risk like super high. But yet it's still yielding me about the same as cash. So this is one where it's kind of a low risk, more risk than cash, but probably a lot more upside potential if something breaks through at some point. So for me, you have kind of a low risk, medium return potential. If you're a person, if you have a decent amount of cash, when it gets down close to like that $30 level or below 31, and you can layer into, I mean, you could add a tiny bit here and a tiny bit on the way down and a tiny bit if it goes deep. I mean, I usually do mine in one big chunk so I can be clear about when to buy when I'm writing. I mean, I have to write about this. Like if you're just investing yourself, you don't really have to do that. So yeah, I think it's pretty interesting here. I wouldn't go like super overweight it, but I mean, put it in there. You get your yield. It's probably not going to drop 50%. But you do have 50% upside potential if something good happens. So that's how I think about Pfizer. I think we've avoided the worst of the bust, and now you can definitely, hopefully, these investors are all bummed and ready to get out of this Pfizer and just go take their 5% cash, and that's when we want to come in and buy the stock when people don't like it. All right, if anybody has any more requests, put them in the comments. If it's in the S&P 500, I will post a free YouTube video at some point on it. If it's not in the S&P 500, I take those requests over on Patreon. You can also get a big discount on my full service if you go over to Patreon, but you don't have to. I have a link down there. You can just go directly to the Cyclical Investors Club Premium. And then I have all the spreadsheets, pretty much everything. I have other strategies. You can chat with me at any time. There's all kinds of stuff there. So if you click that link, you can check that out too. And I have a list here, so I'm going to keep posting videos, and I'll see everybody later.